The yield curve is one of the most watched charts in finance. Let's break down what it actually tells us about the economy. At its core, a yield is simply the interest rate you earn for holding a government bond over a specific period of time. Investors look at the difference between short-term and long-term bonds to gauge market expectations for growth and inflation. The shape of the curve shifts based on what bond buyers expect will happen to the economy in the coming years. A normal curve slopes upward, reflecting risk over time. An inverted curve is unusual because short-term rates end up paying more than long-term ones. When you plot these yields on a graph, the line shows you the current cost of borrowing money across different time horizons. While it is a powerful tool for analysts, remember that financial markets are complex, and no single indicator can predict everything perfectly. Thanks for watching. Understanding the yield curve helps you grasp how debt markets function. Subscribe for more finance basics.